Hi there, and welcome to our video on calls versus puts, what's the difference, and how to read an option chain. Today, we're going to take a deep dive into what these options trading strategies are, and what is the difference between them, specifically for beginners. Let us have a brief knowledge about options calls and puts. Option calls. Option calls are financial contracts that give the holder the right, but not the obligation, to buy a specified underlying asset at a predetermined price, strike price, within a specific time period. They are commonly used by investors to benefit from potential price increases in the underlying asset. Calls provide the opportunity for profit if the asset's price rises above the strike price, allowing the holder to buy the asset at a lower price. Option puts. Option puts are financial contracts that grant the holder the right, but not the obligation, to sell a specified underlying asset at a predetermined price, strike price, within a specific time period. They are often used by investors to capitalize on potential price declines in the underlying asset. Puts provide the opportunity for profit if the asset's price falls below the strike price, enabling the holder to sell the asset at a higher price. Difference between calls and puts. 1. Definition. A call option is a financial contract that gives the holder the right, but not the obligation, to buy an underlying asset at a predetermined price within a specific time period. Conversely, a put option grants the holder the right, but not the obligation, to sell an underlying asset at a predetermined price within a specific time period. 2. Directional bias. Call options are typically used when an investor expects the price of the underlying asset to rise. Put options, on the other hand, are employed when an investor anticipates the price of the underlying asset to decline. 3. Profit potential. With call options, the profit potential is unlimited if the price of the underlying asset rises significantly above the strike price. However, the holder of a put option profits when the price of the underlying asset falls below the strike price, up to a maximum of the strike price. 4. Risk exposure. The risk in call options is limited to the premium paid for the option contract. In contrast, the risk for put options is also limited to the premium paid. 5. Price relationship. The price of call options generally increases as the price of the underlying asset rises. Conversely, put options tend to become more expensive as the price of the underlying asset falls. 6. Strategy for investors. Call options are often used by investors seeking to capitalize on bullish market conditions or specific upward price movements. Put options are favored by investors looking to profit from bearish market conditions or specific downward price movements. 7. Volatility impact. High volatility tends to increase the value of both call and put options. However, call options benefit more from increasing volatility, as it enhances the potential for larger price movements. 8. Time sensitivity. Both call and put options are time sensitive. As the expiration date approaches, the value of the option may decline due to diminishing time value. 9. Obligation. It's important to note that holders of call options have the right, but not the obligation, to exercise the option. Conversely, holders of put options have the right, but not the obligation, to sell the underlying asset. 10. Application. Call and put options are widely used in various trading and investment strategies, including hedging, speculation, income generation, and risk management. How to read an option chain. Reading an option chain is essential for understanding the available options contracts for a particular underlying asset. Here's a simplified explanation of how to read an option chain in 3 paragraphs. 1. Understanding the format. An option chain is typically presented in a tabular format, with columns representing different aspects of the options contracts. The key columns to focus on include the strike price, the expiration date, the call options, and the put options. The strike price refers to the predetermined price at which the option can be exercised. The expiration date signifies the deadline for exercising the option. The call options section lists the available call contracts at various strike prices and expiration dates, while the put options section displays the put contracts. 2. Evaluating the call options. In the call options section, each row represents a specific strike price, and the corresponding columns provide relevant data such as the bid and ask prices, the volume, and the open interest. The bid price refers to the highest price a buyer is willing to pay for the option, while the ask price represents the lowest price at which a seller is willing to sell the option. The volume indicates the number of contracts traded during a given period, while the open interest represents the total number of contracts that have not been closed or exercised. By comparing the bid-ask spread, volume, and open interest, investors can assess the liquidity and trading activity of each call option. 3. Analyzing the put options. Similar to call options, the put options section provides relevant data for each strike price, including bid and ask prices, volume, and open interest. Investors can evaluate the bid-ask spread, volume, and open interest to determine the liquidity and trading activity of put options. Additionally, they can assess the relationship between put options and call options at similar strike prices and expiration dates to identify potential market sentiment and trading opportunities. Example of calls vs puts. Calls example. An investor believes that XYZ Incorporated stock price will increase in the near future due to positive industry news. They decide to purchase a call option on XYZ Incorporated stock with a strike price of $50 and an expiration date in 1 month. This call option gives the investor the right to buy XYZ Incorporated shares at $50 within that 1-month period. If, during that time, XYZ Incorporated stock price rises above $50, let's say to $60, the investor can exercise the call option and buy the shares at the lower strike price of $50. They can then sell the shares at the market price of $60, resulting in a $10 profit per share, excluding the premium paid for the option. Puts example. Now, let's consider a scenario where an investor believes that XYZ Incorporated stock price will decline in response to negative market trends. They purchase a put option on XYZ Incorporated stock with a strike price of $60 and the same expiration date as before. This put option gives the investor the right to sell XYZ Incorporated shares at $60 within the specified time frame. If XYZ Incorporated stock price indeed drops below $60, for instance, to $50, the investor can exercise the put option and sell the shares at the higher strike price of $60. This allows them to profit from the price difference, earning $10 per share, excluding the premium paid for the option. In summary, call options provide investors with the right to buy an underlying asset at a predetermined price, strike price, whereas put options give investors the right to sell the underlying asset at a predetermined price. Calls are typically used when investors expect the price of the underlying asset to rise, while puts are used when they anticipate a decline. Both options provide potential profit opportunities based on the movement of the underlying asset's price relative to the strike price within the specified time period. In conclusion, calls and puts offer investors different rights and profit potential in option trading. Calls provide the right to buy an asset and are used in bullish strategies, while puts grant the right to sell and are used in bearish strategies. Calls have unlimited profit potential as prices rise, while puts have limited profit potential as prices fall. Understanding the differences and selecting the appropriate option based on market outlook and investment goals is essential for successful trading. However, as with any investment strategy, it's important to do your research and consult with a financial advisor before making any decisions. We hope you found this video informative, and we encourage you to like, subscribe, and leave a comment below with any questions or feedback. Thank you for watching, and we look forward to bringing you more informative content in the future. And we'll see you in the next video.